Hi, and welcome to part 2 of my 3-part series on bond ladders, how to buy an individual bond. This series is inspired by my most popular blog post, Annuities and Bond Ladders. Are they comparable? Which I posted on retirementjourneys.com March 2015. As you will see, there are many things to consider when buying a bond. I'm simply sharing my experience, which is informational and illustrative only. I am not a financial advisor, and this is not a course or a recommendation. I encourage you to work with your financial advisor if you're interested in individual bonds and in laddering. Now, before I started to build my bond ladder, I first had to come up to speed when it comes to buying bonds because I had never bought a publicly traded bond. And while I was familiar with stock trading and investing, I had a lot of apprehension and uncertainty about stepping into the bond market. So before I took that first step, I decided that I was going to do some research. I went to Fidelity.com and I looked up fixed income products on their website, and I compiled a list of questions. I then called their fixed income department and spoke with a fixed income specialist. And over the course of an hour, I learned a lot about what to look for when buying a bond. Then, before building my bond ladder, I decided to take what I call a test drive. And by that I mean I bought one bond and I held it to maturity. I selected a bond that matured in just a few months and had one scheduled interest payment. When I went to buy my bond, I called Fidelity's fixed income department and I had them look over my shoulder during the purchase process to make sure that I didn't make any mistakes. I'm pleased to report that my test drive was a success. I received my interest payment on schedule, and when the bond reached maturity, the entire principal was returned to my account as expected. And as a result of my test drive, I felt comfortable enough to build my own bond ladder, take it to the next level. Now, before buying bonds, it's important to understand some terms and definitions. First, type of bond. Now when it comes to my ladder, I focus exclusively on corporate bonds and notes available in the secondary market as opposed to new issues or other types of bonds. Other types of bonds, agency bonds, U.S. government bonds, municipal bonds, CDs even. Maturity date. This is very important because it's related to building the rungs in your ladder, and it's when the bond issuer returns the bond's principal to you. Note that the principal is different than the cost that you pay for the bond, which is largely determined by prevailing interest rates, and I'll talk about that more in my next slide. Yield to maturity. This is a calculation that shows total return for the bond if you hold the bond to maturity. It equals all the interest payments you'll receive and assumes that you will invest them at the interest payment rate the same as the current yield on the bond, plus any gain or loss. Yield to worst. We want to avoid anything that has worst in the name. But what this really means is that it's a yield on the bond you receive if the bond is called or has what's called sinking fund protection. Now, explaining call protection and sinking fund protection is outside the scope of this presentation. What I will say is that bonds that have either callable provisions or sinking funds have them because they are primarily advantageous to, guess who? The bond issuer. And when I search for bonds, I exclude those that are callable or that have sinking funds. Brief mention of zero coupon bonds. These are bonds that sell at a deep discount. Buyers receive one lump sum when the bond matures, but they're not good for bond ladders because they don't pay interest regularly and have very long maturities. And extremely important when it comes to selecting your bonds are the Moody's and Standard & Poor's bond ratings. They're roughly divided into two categories, investment grade bonds and what's called non-investment grades, or you're probably familiar with high yield bonds or junk bonds. Now for me, I tend to stick with the Moody's A2 to AAA and the S&P 500 A to AAA. And they're in the upper medium range of investment grade. And as you know, a bond down here is going to pay more because these companies have to pay more to attract investment. These are going to have lower yields because they have less risk associated with them. Okay, so let's move on to price and cost. Now, I think when it comes to understanding how much a bond costs, this statement sums it up pretty well. Buying a bond is like buying a stock without knowing the size of the commission or the price that it's based on. Generally, the factor that influences a bond more than any other is the level of prevailing interest rates in the economy. When interest rates rise, the price of the bonds in the market fall, thereby raising the yield of the older bonds and bringing them into line with newer bonds. When interest rates fall, bond prices rise, thereby lowering the yield of the older bonds to bring them into line with newer bonds that are being issued with the prevailing lower interest rates. Then there's a concept of bid, ask, and markup. So the bid price is simply what the buyer is willing to pay for security, and the ask is the minimum price that a seller is willing to sell for the security, to receive for the security, And the difference between the price a broker-dealer pays for the bond and the price at which it is sold to you is known as the bond's markup. And that's what you will pay, is that difference. And your costs will, of course, include that price, and that's the price of the bond times the number of lots. And a lot is equal to a bond lot is $1,000 or one bond, so you may buy 5 or 10 or 1. That's what they mean by lot. And the broker-dealer, in this case, may charge a transaction fee as well. And Fidelity charges, I think, $1 per bond. And then there's any accrued interest. So if you're buying your bond and there's 3 months of interest that's already being accrued, you get that, so you're kind of paying yourself. But all that together equals the total cost that you pay for your bond. So next I'm going to do a little online demo and actually search for bonds, show you how I search for bonds, select the bond, research a bond, and then the actual mechanics of buying a bond. So here's a couple screens that we go through to get to the point where we can actually search for our bonds. I'm just going to click through here. And then I'm going to be looking at individual bonds. And I'm going to search for corporate bonds. And there's your CDs, agency, municipal bonds. But this is where I build my bond ladders from. Okay, so there's 6,671 CUSIPs, and a CUSIP is a serial number. It's a unique identifier for your bond, or for all bonds. And I'm going to do this search just for the year 2018. So we're going to say it goes from January through 2018. So that should say January. Then we'll go through December again of 2018. And that narrows it down to 592 bonds. And as I said before, we're going to take our Moody's from A2 to all, or AAA, and we're going to take these from A to AAA as well. Takes it down to 297. And I'm going to click on Show More Criteria. And in this case, as you know, I do not want zero coupon bonds. I do want call protection. It defaults to seeking fund protection, which is great. And we're down to just 91 bonds, a much more manageable number. So here's our list of available bonds, and they're sorted in terms of maturity date, with the newest coming first, and then December would be at the very bottom. And we have the description of the bond here, the coupon rate at the time it was issued, when it's a new bond, when it matures, the Moody's and Standard & Poor's ratings, and the price for the bond. And in most cases, you're going to pay more for the bond than face value because interest rates have been going down. And the yield to maturity, which is the yield that I look for. I'm not going to talk about these other parameters here. That's outside the scope. And what I've done is I've pre-selected this particular bond, Wachovia, and it's 5 3/4, and it matures in February of 2018. So we'll click on that and see where we go. So now we're taken to a screen where we have all of this information, our CUSIP, our serial number. We confirm that we have call protection, that we have sinking fund protection. The minimum investment quantity is 1, which is great. That means you can buy just one bond if you want, instead of sometimes they restrict it to 5, 10, or even more, and you may not want to spend that kind of money on just one bond. We have our issue date. So this bond was issued back in 2008. The next coupon is in February of 2017, so it's paid semi-annually, August and February. Workout date, that's really maturity date. That's when you're going to get your last interest payment and when the maturity will, when the principal will be returned to you. So I clicked on the next tab adjacent to Overview, Price and Performance. There's your bid and ask price. I'm not going to get into too much of that. The yield to maturities, again, these are things that you could learn more about if you wish. I'm just kind of showing you the minimum criteria that I use, that I follow, that I pay attention to. And there's my price. That's probably what you end up having to pay for your bond. So a $1,000 bond is going to cost you $1,050 basically, and that's again to adjust for interest rates. And there's these other parameters here, and I'm going to go ahead and click on buy. If you're really curious, I think there's recent trades. You could view recent trades. I don't put too much stock in this because most of them have to do with dealer to dealer and kind of more institutional trading than what individual retail buyers are doing. So I shrunk this window down a little bit just to protect my personal information. And part of the screen that I get is this transaction area where you can buy or sell. And you can view the bond details again, or what's called depth of book. In this case, I think the minimum quantity was 1, so we're gonna stick with 1. And there's that limit price. I think it's actually just a tick higher than what the ask price was. So it's a little bit higher. In stocks, I never buy a stock unless it's a limit. And I've tried buying bonds at limit for the entire day. I've never been able to buy a bond using the limit features like you would on a stock. So, I just go with what they. So my bond is going to cost me that much. I use the fill or kill I could put for the day, but that works because I just accept their price, and you'll see what happens when I click on preview order. So the first half of the screen just reminds you that one bond equals $1,000 in face value, so the lot quantity is 1. And the limit price I entered has been adjusted to reflect a concession. Guess who's making the concession? Based on the number and type of bonds you're attempting to purchase. So here's a review of the order. There's my unique identifier. I'm buying this bond, 1 quantity. That's the initial coupon rate, maturity date, today's date. The settlement date, that's when everything will be worked out in terms of all the prices hitting all the different books. That's my price. Fill or kill as opposed to day. Cash, limit price, with a concession. Isn't that nice? It's actually going to cost me that much more. That's a little concession that they were talking about. And the effective yield, not so bad in the grander scheme of things. And there's $8.15 of interest accrued because I think the interest was paid in August. I think that's August and February. So there's my price. There's Fidelity's $1 commission. And so to buy this bond, this $1,000 bond that's yielding 1.27, it's going to cost me $1,068. And there you have it. That's what it takes to buy a bond at the most basic level. Again, I encourage you to work with your financial advisor, to talk to them, to learn more about bonds. If you're interested in laddering, it's a lot of fun, and I think it's a great option when it comes to income replacement. Now, to conclude my 3-part series, part 3 is going to be where I show you how to build a 5-year ladder. And again, I'll focus on corporate bonds from the secondary market, and I'll use Fidelity's bond ladder tool. It makes it super easy. And I'll also explain how I use the bond ladder tool just for selecting bonds. And if you have any comments or questions, you can use the contact form on the Retirement Journeys homepage to ask them. Again, thanks for your attention. Thanks for joining me for part 2, and I look forward to seeing you for part 3, the final episode. Take it easy.